Well, good morning, everyone. We are here. We've made it to day 5. It's Friday, day 5 of our webinar series of New Year, tax year ends, trying to give you some up-to-date information on EIS and SEIS as we head into those 2 important dates, 31st of January and 6th of April for tax planners and financial advisors. So thanks very much for joining us if you have done it every day. Thanks very much if you joined us, if you dipped in and out. And thanks very much for joining us if it's your first day. So today is new territory for all of us. I'm slightly nervous, I'm not going to lie. This is really a session for anyone who's watching, for all attendees. So please do join in. Please do put some questions forward on the Q&A or on the chat, whichever one you can. The more questions we have, the better. So please don't be shy. If Nick Polzone is watching, he's asked a question every day. So Nick, please ask him as many questions as you like today. We do have some kind of set up ready to go because some of you very kindly sent some in beforehand, but we really do need some questions to come through on the Q&A and chat. So please send some through, or this session might be a very short one. So we have 1, 2, 3, 4, 5 hander today. So let them introduce themselves, I should say, all of our panelists today. So I'm going left to right. Stephen, do you want to go first?
Hi, morning everybody. Thank you for joining. Stephen Margolis. I'm the chair and founder of the ARI Capital Group, and we have the ARI EIS Tech Fund.
Short and sweet. You almost caught me out there. Andrew, over to you.
Hi there. Morning, everyone. Andrew Noble, partner at Power Equity. We are an early stage investor based up in Edinburgh, investing across the north of the UK. We've been investing since 2008, and to date, we've backed 61 companies, of which we've realized 22, and producing some quite handsome returns for our investors over that period. We focus on enterprise technology mostly, so we're out looking for the very best deals in the market right now. Thanks very much.
Thank you very much, Andrew. Daniel.
That's me. Hi guys, Dan Rodwell, Chief Executive of Growth Invest. Firstly, thanks very much, Mark and the ESA team for having us on today. I'm very much looking forward to it. Growth Invest is an advisor-focused platform that specialises in tax-efficient and alternative investments, so EIS, VCT, IHT, and other products. We work with advisors to solve frictions around the tax-efficient space, and we give them the ability to diversify efficiently, manage portfolios effectively so that they can focus on, compliantly entering the space, or more importantly, growing this area of their business.
Thank you very much. So it must be James next.
Hello, good morning. Thank you for the opportunity. My name is James Faulkner. I'm one of the founders and a director at Vala Capital. We were created a few years ago now. We're onto our 6th tranche of investment, but set up by a group of serial successful entrepreneurs who had another great set of companies that needed further backing, and we continue to invest in that way. We've also recently launched, for those who joined Wednesday's seminar on ESG and sustainability, we recently launched a second EIS, the Sustainable Growth EIS, focused on companies themselves that are focused on solving some of the challenges to this planet. So established EIS manager and looking after high growth businesses and through the enterprise investment scheme.
Well, lovely job, Fred. Sorry I left you till last, but over to you.
Morning all, I'm Fred, co-founder and partner at Hatch. We're about 7 years old, but primarily as angel investors for the first 4.5, 5 years of that. A couple of years ago, we launched our EIS fund, Hatch Ventures. We specialize in investing in pre-seed and seed digital and technology deals all across the UK. We're based in Stamford in Lincolnshire, which no one's ever heard of, but it's in the countryside, between tier 2, tier 3 and tier 4. So we cover it all here. So look forward to the session.
We're all in lockdown now, Fred, so it doesn't matter what tier you're in. So we're all fine. Stanford's a lovely part of the world, but if you are near Stanford, go and have a look. It's a great place. So, okay, here we are. Let's get started then. I see there's a couple of bits and pieces coming through the chat and the Q&A already, so thank you very much for doing that. Please keep that going. You'll see also I put a link in the chat, and that link is to some videos that we've done. So we've done with some of these guys and some of the other panelists we've had during the week, We've done some sessions with them, kind of short and sharp videos, looking at the tax year end, trying to give you some ideas, trying to give you some thoughts, plans, insights. It's the things you might want to be thinking about within this sector for tax year end. So they're well worth picking up. I think we've got 5 or 6 videos and we've still got a few to put on there. So do click on that link, not now because we're busy, but at some point during your busy working week, go and have a look at those. Okay, so I'd say questions starting to come through. I've got a couple lined up from previously in the week. So let's kick off and have a look at those. So first question, are you having to do extra DD on investment companies due to COVID-19? Who should I go to first? James, I'll go to you first.
Well, the rather glib answer is no, because we'd be expecting to do a shed load of DD on each of the companies anyway. And it's been an interesting experience going through this, but the advantage of the enterprise investment scheme is that when we do a new tranche of investment, you're looking at all those companies afresh. That's the opportunity that you have. New investors who are coming in at that point will get effectively a new set of investments. So you look at each of the companies, whether they're follow-on funding in your own portfolio or new companies, to see how they're doing. And part of the context of that, obviously, now is the response to COVID. So it does sound slightly glib, but what we are looking at is each company afresh. How are they doing now? And of course, part of that is how are they doing in response to COVID? So I don't think it's extra. I think it's just part of the job that we should be doing as managers.
Yeah, is it the same for you, Fred, that literally COVID is a bit of a red herring in a sense? You don't need to do any more or any less DD. It's just keep calm and carry on.
Yeah, I think I agree. I guess what we see in tech throughout COVID is a lot of new companies. I think deal flow has actually gone up. So DD is, of course, more important than ever. And for us, maybe at that top filtering level of inbound leads and making sure that they're right to enter our DD pipe. What we don't want to do is put 100 deals through DD a month and then be spread too thinly. So same DD, absolutely agree with James, just slightly larger volume we've seen.
Someone's dog didn't like your answer, Fred, I don't think, but I liked it. It was a good answer. Stephen, just going to you on a similar theme. Are you seeing more or less companies? Obviously, there's a lot of talk around people being furloughed and then starting up their own company. This is the opportunity they've always been waiting for, almost, to start up their own company. Are you seeing more deal flow, or is it leveled off a little bit?
I'm not actively looking for deal flow. We're a small fund. And so I need to support the companies that I've agreed to support. I would say I'm taking a slightly different view to my colleagues here. I think companies do have to pass what I'm calling a COVID test and understand what impact COVID has had on those companies and their sustainability going forward. And also the impact on potential valuations and in investing in those companies. So, the question is, how have you managed going through COVID? What adjustments have you had to make, and what impact will that have on your growth going forward? And that's just kind of the approach. So, I've taken a slightly different view as to the new companies coming through. Yes, I get various proposals sent to me, but I'm not actively looking at them. I'm wanting to support the companies that we've got right now.
Okay. And in terms of fundraising this year, Angie, obviously we're heading into 6th of April, kind of squeaky bum time for anyone trying to raise money at this time. Are you seeing good deal flow? Well, two things. One, good deal flow, and two, are you seeing money come in from investors at this moment of time?
Yeah, we are generally. I think that the inflows have been good. I mean, when we look back on 2020, despite it being such a challenging year, we've actually increased our inflows of capital again. That's partly because we're sort of somewhat of an emerging manager and we're growing our profile across the UK. But we're also sort of balancing that up with decent deal flow too. So we saw deal flow slightly, come off the boil in April, May for understandable reasons. But since then, our run rate of deal flows ticked up to sort of record highs. We've got 3 or 4 new deals that will be closing out by the end of the tax year. So we're able to consider accelerated deployment should there be investors out there looking for that. But generally speaking, we feel comfortable given the state of play on things. We are keeping a close eye on the VCT fundraising because, you know, from an advisor's perspective, they do tend to consider VCTs before EIS, and therefore there's a filter effect there. So if VCTs have a good or a bad season, that may well reflect good or bad on EIS coming into the end of March. So we are keeping a close eye on that too, and seeing how that might unfold for us as managers.
How dare you mention VCTs in an EIS session, by the way. But do you see that as a leading indicator, do you, in terms of VCTs and how that fundraise? Because that tends to come, as you say, slightly earlier.
I think it's a bit of a bellwether for us in terms of investor sentiment towards the asset class as a whole.
Gotcha. Okay.
Can I just add in there on the COVID point? And you know, I agree with Stephen. Of course, we can't do anything without looking through the lens of COVID. I mean, it just had an effect on everything. And of course, what we're looking for as a manager and who we're working with is those great management teams in each company. So part of what we're identifying is how well they've coped with the challenges that they've had. Now, Fred's right that some of those companies have emerged during COVID, and there's been many companies that have thrived during COVID. But what we want to know is how well the management teams have responded in this time of challenge. You know, companies like ours, like Vala, made up of entrepreneurs who've been through that cycle before, in terms of other challenges, can provide mentoring and support to those businesses and management teams. But what we're looking for is how well they've responded, and that's a really important part of the due diligence that we do.
I guess that's part of the reason why companies have a fund manager involved, because it's not just the money they're getting from you guys, it's your expertise, your contacts, and all that experience that goes with it as well. Stephen, there's a question that's come through, particularly for you, talking about your COVID test that you mentioned a minute ago. So asking, how does your COVID test influence your actions, i.e., at what point do you cut your losses, and if so, is there any financial recovery in terms of security of assets? So,
well,
pick that one up?
Yes, we play. I've yet to have to cut my losses. So we've managed the company through, and you know, in some cases they've trimmed down what's necessary, what's the low-hanging fruit, where we were involved, and I'm talking also about the VC side of what I do as well. So whereas you may have an R&D department that's looking at a number of different angles, okay, what deals need to be closed? Don't focus your business as to where your early revenues are going to be, and focus on what are the must-haves and not the good-to-haves or the nice-to-haves. And very often the tech companies, in my experience, has been they're chasing everything, and as an investor, you're supporting that. And I'm saying just focus on what you need to focus on. Let's get through this, and you build on your credibility. So it really is focused on unnecessary expense, extending your own internal runway so that you can manage your way through it. And are there alternative ways of running your business, and where can you make your savings?
Sure, but for those companies that do unfortunately go pop and go bust, is that the fact as an investor your money has then gone, or is there any kind of recovery they can get from that particular company? I know it's different in every circumstance, so can't generalize on these things. But
I can only talk from what we've done on the VC side, and we have got one company which was in the employment space, just put their tech into deep freeze. They'll come back. They were doing very well as vacancies dried up because shops are closed and so on and so forth. I've just had to say to them, you're going to have to find yourself. And actually, I've used their experience and introduced them to another company, the management into another company that I'm supporting, where I believe that their management experience could help grow that business. So I'm trying to help them out as individuals, and we'll come back to their technology when the economy picks up.
Sure. And Fred, Dan, I'm not annoying you. I've got questions just for you in a minute, but hold on a sec. Fred, COVID's created winners and losers. You know, it's been pretty obvious. But for those companies in sectors, and I'm thinking of travel, hospitality, leisure, for example. So let's say, you know, 1st of January 2020, you found a great travel company, had all the things you wanted to see in a company. It's in that sector, but obviously it's been massively hit in this particular year. now they're looking for perhaps more funding. Would you still go with that company? Do you cut them off and say, see you later? What approach do you take to them?
We're always very bullish on opportunities, and I think the pandemic created opportunities to be bullish again. And we have although we only invest in digitals, but we do have a company in travel and hospitality, and they were, there's no denying, they were hit by COVID. They specialize in resort management software for luxury resorts, predominantly in the Maldives and Southeast Asia market. And that market was one of the first markets to shut down. What they did do, though, and how they pivoted really during the pandemic, is used it as a land grab opportunity. So suddenly the view was, actually these resorts are shut and guests are not going to be going into these countries and not going to these resorts for the next 3, 6, 9 months. What can we do in that period? And actually what happened is that the resort operations and management were all gearing up for their launch, big Christmas launch in the Maldives, very busy. And there was the opportunity to implement the software because they were not focused on guest queries and questions. They were focused on what can they do to improve their experience when guests come back. So I think any vertical in life through any pandemic always comes back. We're all dying to go on holiday, and some of us has managed to get away or not. And I think travel, is ripe for disruption again. So yeah, we're always quite bullish.
Dan, I did say I was going to ask you a question, and I am. I talked to Stephen a minute ago about what happens when a company fails in a portfolio. But what happens when the whole fund fails? What's the situation there? What's the process?
Well, it's a really good question, and it's pretty broad because, as many will know, over the last 12 to 24 months, we've seen problems with custodians, we've seen problems with EIS promoters, and also with funds specifically. I think the most important thing to remember here is that with a fund, it's a managed service. So ultimately the assets are held by the underlying investor or client. So if the fund wrapper itself were to fail, that doesn't necessarily say that all the assets within that fund have failed themselves. If the underlying companies fail, then obviously the client can use mitigators such as loss relief and so on and so forth. If the fund itself fails, then kind of as we're seeing playing out, there's a number of things that can happen. The client may have access to FSCS dependent on circumstances. It's highly likely that those assets will still have a value, and in some cases they may be transferred directly back to the underlying client. In other cases, as I think we're seeing in the market now, those underlying company assets can be transferred to another manager. So it's a very different thing. We in the EIS space, we invest in managed portfolios, so we have a holding of underlying companies, and there is risk in the sector, so there should be an expectation that some of these underlying companies are going to fail, and then you use the loss relief. From a fund perspective, in some cases it may matter not that the fund has actually gone into administration if those assets get transferred elsewhere and continue to be managed, and the portfolio returns could be as good as they ever would have been.
Yeah, I think the important thing is to be transparent about these things and say, look, this is happening, but this is why it's happening. This is what's going to happen as a result of that. Companies fail, funds fail in all different sectors and economies. So I think it's just up to us as an industry to be up clear and upfront about that. Dan, there's questions to you like buses, because there's another one just coming. It's clearly a fan of yours, or your wife sent a question saying, Dan's offering is key to the success of EIS and VCT, as it makes life simpler for DD and storage certificates. Generally speaking, we need to ensure the customer experience and journey is simple and smooth. So in terms of what you guys have been doing, how do you make that customer journey simple and smooth, or how can we make it even better, in fact?
Well, your last point's very relevant. Everything we do is an ongoing process to try and make life easier for both the advisors and for the experience for the underlying client. But the first thing to say, a platform to consolidate and centralize access to this space, we felt was always absolutely very, very important. We know that EIS assets post a patient capital review, which was quite a few years ago now, but still very relevant. EIS assets are risky assets. We are investing in portfolios of high growth companies, so diversification is super important. The customer, i.e. the advisor and the client, needs a simple a process, and within our platform that's digital, to access multiple different fund managers, and then likewise with the industry underpinned by tax incentives. There's a lot of paperwork that flies around, and reporting that comes from various different funds at any one time, and so to be able to pull to one central repository and give real portfolio management across the whole industry is very important for for governance within the advisor firm, and for efficient diversification. So they're the fundamental themes around what we do and how we make life easier for the advisor. We also do a number of things around assisting with suitability, fee illustrations, and parts of the process that are relatively clunky for an advisor firm to get through to actually advise on this space.
And certainly, James, what sort of work do you do with advisors to let them know, what's happening with the companies they've invested into, what's happening with your fund as a whole, in terms of the whole reporting process? What do you guys do?
Yeah, so part of the answer to the question is about making as much digital as possible, not for its own sake, but because that tends to be a quite efficient way of transferring knowledge, also a secure way of doing it. So with us, you can do digital applications, so making it as paper-free as possible, and makes it nice and easy, or can make it nice and easy, but also giving investors and their advisors access through a portal to all their information. So that's live, not that we update the share prices on a live basis, but whenever they need to get an update, they can go onto the system and look at what's happening and what the value of their holdings are. That's also the repository for EIS3 certificates and any other fund updates. So that tends to be the medium through which people access information about the Vala portfolios. As a house, what we do is we report, I think like most others, twice a year. So there's a reporting point, a formal reporting point twice a year. For us, that follows October the 5th and April the 5th, when we'll put together a fund report on the progress of the companies within a client's portfolio, the share prices, that kind of thing. So that's again sits within the portal, but that's done twice a year. And then of course, if there's anything happening in between, any big company news, for good or I guess for bad, but any interesting information, that will be put on the portal as well, and a note sent to advisors and investors. So that tends to be how we look after the flow of information and things like EIS3 certificates.
Yeah, and I must say, I think the industry's got a whole lot better certainly in the last 2 or 3 years with getting information back to investors. Obviously, most of you guys now all have portals and ways of communicating with clients, which is much better than it has been. So I think that's been a positive over the last couple of years.
I mean, we do. It's not to say we don't want to talk to investors. We love to. I mean, if they want to give us a call, or arrange to have a conversation, we'd love that. So that's great. But it tends to be a more convenient way of doing it. So it's not to say we don't want to talk to them. We do, but that might just suit many people.
Brilliant. And I realise we're kind of moving around and jumping around a little bit, and that's probably quite deliberate in some ways. And I'm not asking all the guys to answer every single question, because I think most of the time we've probably got the answer when we've asked a couple of the guys. So just trying to get through as many of your questions as possible, which so still keep pushing them through. I know there's some on the chat and there's some on the Q&A, so please keep sending them through. There's one here asking about are wealth managers, IFAs, accountants looking any further across EIS and SEIS funds and single company landscape for their clients, rather than for the same old fund? So yeah, I guess it's always been a bit of a bugbear of mine when you look across the industry, when you see the stats of who's raising the most money, it's normally kind of the usual 4 or 5, which are great fund managers. I'm not trying to put those fund managers down in any way, shape or form, but there are 60 funds in the whole landscape of EIS and SEIS. It'd be nice to see kind of that money spread around a little bit more, and there's some great managers at the top end, at the middle, and at the bottom end in terms of being new funds as well. So anything you guys can think of that we can do to help IFAs or wealth managers to understand the kind of the breadth and depth of EIS funds and how we can get them to spread their investments a little bit more than just the same old usual funds in that sense? Andrew, I'll go to you.
Yeah, I think it's a really good question. I think from an advisor's point of view, you want diversification in EIS. We would all, I think, nod and agree that when you're investing into EIS, you don't want to go for a rifle shot approach. That would be very risky. And instead, you want to build up a portfolio of 30 plus EIS investments to show you've got good diversification across the underlying assets. But I think if you're an advisor and investor looking at EIS as an asset class and you're thinking about using EIS funds to get that level of diversification, you might also want to think about manager diversification too, which is really important, especially, we've seen what's happened to Earthworm. You're going to want to diversify across different managers. And that's not only in terms of reducing your risk, but also increasing your exposure to different investment strategies. So for example, some managers might focus exclusively on the Southeast. Other managers like Power Equity will focus more on the north of the UK. In addition, at Power Equity, we tend to focus much more on enterprise technology rather than consumer-facing technology. So there are ways in which advisors and investors can increase the sort of breadth and diversification of their underlying assets by handpicking specific managers that they want to work with around the country.
Brilliant, thank you very much. Again, just kind of moving around a little bit. There's a question coming in around fees. We had obviously a session of fees the other day, but so this question says that according to MyCap, fund AMCs have crept up in the last 2 years rather than down. Can you explain why? Dan, I'll go to you on that one.
It is an interesting one. I think it ties into the wider debate around fees, but I think that is accurate, and that across the market that the AMCs have ticked up. I don't think that's because the input costs of running a fund have increased. What I do think is that there's most definitely, as fees become more transparent, which is absolutely necessary for the growth of the industry, I think there has been pressure on initial fees, certainly, and also pressure on placement fees that are charged to the companies. As we improve the transparency in the industry, moving more towards a traditional fund kind of 2 and 20 model or something like that, some of the initial and one-off transactional fees are reducing, and as such the managers need to make some money in the middle and ongoing to manage these companies. And I think that's a good thing from my perspective, because one of the most important factors in outcomes for EIS portfolios is hands-on management from the rest of my colleagues on this call, right? It's all about working closely with these companies to get the best outcomes, and that's easier done when you're well funded. So the cost of an ongoing charge, which means that the manager is adequately resourced to work closely with these companies in the long term, I think is very important. And I think it's a much more stable situation than just having a high initial fee that the fund can take early in the process, and then they're not incentivized to continue to work closely with the underlying assets.
I think the part of it is I mean, I was surprised to see that question. I wasn't aware that AMCs had been creeping up, but that's obviously the case. I mean, it could be partly to do with the overall, as Dan was saying, the overall fee burden over the lifetime of an investment. I mean, at Vala, on our Vala ES portfolio, we took the decision not to have AMCs at all because of the nature of the way we do things. I mean, we don't charge them to underlying investee companies or to investors, because we felt that was a fairer way of doing it, and the lifetime cost for Vala is 6%. For the Vala EIS portfolio. So we came in and did something, slightly different. But I think what's moved on, and it is, Dan's right, partly it's about, not just about transparency, but also about simple and clear. There's such a multi-layered approach to fees, and I think that's got one of the things that's got to come out. And the other frustration is is the idea that reassuringly expensive. I think that's got to disappear as well. The days of poor performance but the fund managers making money has got to end. Our remuneration must be based on the outcomes for the investors, and Dan's right, it's got to be sustainable, and we've got to be fairly remunerated for the work that we're doing. That's fair, but overall it's got to be based on the returns to the investors, and this idea of reassuringly expensive, you get what you pay for, has got to go, because managers got to be fair.
Yeah, absolutely. So yeah, obviously we had a session on fees and transparency the other day. You can still catch it, by the way. It's on our website as a video. So, but I guess my final call on that one would be, a co-investor, as we mentioned on that call, have introduced a calculator, so you can go on there and kind of compare and contrast some of these guys' fund manager fees. And obviously we've done our fee transparency subject as well, and you can have a look at that at the same time. Moving on, more questions coming through, which is great. Conflict of interest policies. Do you have conflict of interest policies, and do you publish them anywhere? Stephen, do you have a conflict of interest policy?
Yes, we do, in that we ensure that we, from a management point of view, we're not FCA registered, so we work with someone that is FCA registered, and we work with an independent custodian. So they are our referees to make sure that we are doing what we say we're going to do. In terms of the investee companies that we are involved in, yes, we do get involved in those companies, and we are very supportive of them. What we also do, though, is make sure that there are other independent directors involved to make sure that we are not conflicted. We don't always invest in the investee companies ourselves. Some investors like to see us have some skin in the game. Others raise the conflict of interest point. Where the conflict of interest has more often come up is that we also have a very big VC fund. And the idea is that the VC fund can follow on. So are we forcing an investee EIS company to always take our VC money? And the short answer to that is no. The way we run this, we will make a proposal if we want to make a proposal. We're never in control. We can't influence it. What we try and say is, look, as a founder, we don't want you to be spending time trying to raise more money from other VC companies. Here is a proposal. If you think it's fair and the rest of your people think it's fair, take it. If not, then we would support you looking elsewhere. And we're not providing value. So it's kind of a yes or no answer. So we're aware of it. There's always potential for someone pointing a finger, but I think that we've got adequate protections in place.
Sure. And I guess this question goes to kind of wider governance point, Fred, about what you guys as investment managers are looking at, how you make your decisions. I say the conflicts of interest policy there. Again, what position do you take in terms of governance and independence and all those good things?
I'm hoping you can hear me as there's some building work that's just started in the background. Yeah, absolutely. I agree with a lot of points Stephen made. We're an emerging manager. We've transitioned, so we are directly authorised by the FCA now. So we are the fund manager. Of course, we have an independent custodian, so that ticks those boxes. I think the number one conflict of interest area which investors and advisors talk to us about is follow-on investments, to Stephen's point. And we like to invest at pre-seed and seed, and we like to follow on and support our portfolio companies. The view that we've taken on it and the way that we feel works best for our fund is that we allow third-party investors to set those valuations for follow-on investments. So if we invest in a portfolio company 12 months ago and they go on to raise another round, we'd love to participate. And if we can, and if we're in a position to, we will participate. But more often than not, it will be a third-party investor leading that round. Now, for us, that's quite an interesting dynamic, because as entrepreneurs and angel investors ourselves, we feel like we're leaving some gain on the table there, or some money on the table, and allowing others to come in. But I do think third-party valuation is very important, and validation across the portfolio of companies raising from other investors is important as well. So probably 9 out of 10 deals we do are always syndicated with other funds or angels. So I think that provides a lot of comfort to investors. The other point I'd make is that We align ourselves with our investors. So we are angel investors by background. That's what we do. Now we make all of our angel investments into EIS qualifying companies via the EIS fund. So we're aligned with investors. We own about 22% of the fund personally, and we continue to invest in every tranche we do throughout the year. So we're not out there picking and choosing and picking this deal for us and this deal for the fund. Everything goes into the fund, which I think is important.
I guess that probably answers the question just come in. Do you disclose which companies you do invest to, where skin in the game can mitigate some of the conflict of interest? So that pretty much answers that point, I guess, that you are very much aligned with your angel investors, with anyone coming into the fund.
Yeah, and I don't think we should shy away from it either, because lots of our investors get excited about follow-on opportunities. Lots of our investors get excited about investing in not necessarily a slightly later stage deal, but a deal that we've done essentially a year's worth of deal because we understand it. And I know there's some EIS funds out there now that have a specific EIS fund just follow-on investments. We haven't gone that far. We personally, as Hatch, we try and give investors a mix of maybe 4 new companies and one follow-on company in the portfolio, if we can make that happen.
Yeah, and then it's a, I guess, related question that's just come in about: is it easy to discover who actually owns or significantly influences the fund manager? And I guess this question is coming from the fact there can be quite a few moving parts in an EIS fund. There can be an investment manager, an administration manager, and a custodian. There might even be a parent company over and above that. Dan, is there any easy way to find out who actually owns an EIS fund, or who is the kind of the controlling interest in a fund or a portfolio?
Well, every fund has a structure that starts at the top with the discretionary fund manager, and you know, in Fred's case, as he said, they've just transitioned to being directly regulated for that. With some of the other guys, I know that they use, you know, a third-party fund manager, so that person is by definition independent of the fund and is the person you know, carrying the regulatory risk. Underneath that, there is what's called the investment advisor, or it comes by a number of names, but it's the operating company that will engage with the underlying growth companies, do due diligence on them, and ultimately put forward the decision to invest in them going forward, and put that forward to the fund manager for final sign off. So if you're looking at, you know, who has absolute power to you know, influence decisions, you should look at the makeup of the underlying investment advisor company. So you could look at the shareholding there, what constitutes their investment committee, do they have independent directors on their investment committee, and so on and so forth. You can see the makeup of that, and then ultimately you would look at the fund manager per se, and if that person is independent, that should again be one step removed, because nothing goes through without the sign off of the discretionary regulated fund manager.
Brilliant, thank you very much. Moving on to another question, slightly different one this time, because this isn't actually from a financial planner necessarily. It's from someone who's actually starting up their own fund. But we're starting to plan our loan in our first EIS investment, a wine investment fund in May. We expect to get the bulk of investment from clients. How important is it to have an MJ Hudson, Allenbridge, or tax efficient review, or MyCap, or Hardman review? So I think most of you guys have one of those things. What kind of significance do you place on those? How important do you think they are? Andrew, I'll go to you.
Yeah, I think we've learned a lot of lessons actually as we've grown Power Equity over the years. So our EIS fund was launched back in 2012, and it was making sort of investments alongside our angel network of 200 members, and it was really very much a sidecar for passive investors who wanted to get that exposure. Over time, it's grown into something much more meaningful, and something that a lot of advisors have an interest in. But we've only been able to do that through getting analyst reports from Tax Efficient Review, good reports from them, good reports from Allenbridge, good reports from MyCap. And it's only once we've got those good reports can we get onto the panel of some of the larger wealth managers that are out there, because they do require a good analyst review before they even consider doing their diligence on you. And there's a long and extensive process that one has to go through before you start getting on the panel of wealth managers. And it gives you the critical mass to raise more money to make all the investments that you want to make. So in short, it doesn't make too much of a difference in the beginning if you have a large pool of engaged investors around you, and you as a manager want to invest your own money through the EIS fund, as we at PAR do. So like Fred, we've personally put in £4 million of our own personal capital to our portfolio. And that is through the EIS fund and directly into the companies. But then once you want to get critical mass, you do need good reviews from the analysts. And that is a very important piece of the puzzle.
Yeah, it always feels like it's become a bit of a game these days, that you need to get those good reviews, but you can't get a good review until you've been in the market for a long time. You haven't been in the market for a long time, you can't get a high score. If you don't get a high score, you can't get on the panels, and you can't raise the big money. So I say it feels like
some of the analysts won't even review you until you've got a good enough track record. So they won't even bother looking at you until you've made enough investments and maybe even started to make exits. Otherwise, they won't even touch you.
So Stephen, I know Ari's been going a few years now, and it's obviously been, I assume you have some of those reviews. What importance do you place on them? And I guess it's probably a question for any financial planner watching as well, what importance they place on them. Perhaps if you have any ideas, put something on the chat or the Q&A. But Stephen, what's your kind of view on these reports?
And they're absolutely vital. One of my biggest, frustrations is exactly what Andrew and yourself just identified, is there is a significant barrier to entry to get going in the IS market. Everyone said, well, what exits have you had? Well, I'm still trying to raise the money and whatever else. So you go around in this circle. Some platforms will only take on funds. They won't take on single companies. There's a move now towards single companies. And all I can do is talk about my own personal experience. We have been successful in the VC space. And the VC space is now driving our EIS initiative. And that's how we're showing our ability to manage, to perform, what our exits are doing. And that's where I think it's called a challenger fund. I see ourselves as a challenger fund trying to get started. And people, I would hope that advisors would look to understand what we are doing and why we are doing it, and put their toe in the water with us. And that's as much as I can hope for. So back to your question, how important is the review? If you can get one, vital.
So there's a couple of questions coming on this one, actually. Jody, I know it's Jonathan, Jody, by the way. Same as getting your first job, you need experience, but you need a job to get experience. That's life. Yeah, good point.
I think, oh, sorry, Mark, on you go.
No, go on, Andrew, go on.
I was just going to say, I mean, we're trying hard to work with the analysts on the key questions that they should be asking managers. At the end of the day, this game is all about making fantastic investments, supporting companies, creating exits, and overall returning more cash than is invested into your underlying companies and making sure that investors get the best returns possible. And so it is frustrating when the analysts put a lot more weight on other things that quite frankly don't necessarily lead to excellent returns. So at Par Equity, for example, we're now nearing £100 million of realizations for our investors, which is way more than some of the top 5 EIS fund managers in the market. And yet the analysts will mark us down because we don't have the critical AUM that other managers might have through VCTs and larger VC funds. But at the end of the day, as a product, focusing on what we're doing, we're one of the best in the game. But the analysts like to kind of find other ways in which to mark you down. Returns is what this is all about, and it's the key thing that we should be measured on.
Yeah, and that's a good point. Dennis makes a similarly good point that most of the scores that come through from Tax Efficient Review and Alabridge sit around 84 to 85 or 86. You never get a 10 or a 92. It's kind of always within a very small margin of error. So that, he's asking the question, does that make them worthwhile? I think, having been a financial planner, having been doing the DD on this stuff, I always use kind of third-party reports to add to what I've done already in terms of my own due diligence. So it was kind of nice to cross-check with what they'd done, but still it was ultimately our decision who we used, and we would use people who didn't necessarily have the highest scores. That's just the way we did it. So again, good question to ask financial planners watching, how much reliance do you put on these type of reports? And how easy are they to get? James, you want to speak?
Yeah, the other part is and there was a question somebody asked about, if financial planners looking at this area for the first time and less familiar, and part of the role of those independent analysts is and others in the market is to help hone the market for advisors. If there's 60 plus managers or opportunities out there, how do you begin to start? You can't have realistically 60 conversations. So you might start with some of the analysts or with one of those things like MyCap or Allenbridge have moved out of the market as such in that way, but Churchill or one of the platforms growth investors that we've been talking about, to use that to help hone the market and to get to a group of managers or EIS funds that suit what you're trying to achieve for your client. And then you start having the conversation with the manager and understanding exactly what's going on in there. So it might be it's less about the score, although their opinions, of course, will inform some of the questions you might ask, but it might be just a good way of helping honing the market. And that's why it's important for people like Vala coming into the market over the last few years, is so that we're visible and so that people can say, right, I understand what Vala do and where they sit in the market. I want to go and have a conversation with them, or not, as the case may be. So that's the other part, I think, that analysts and things like that have to play.
Yeah, and I should say I'm not trying to put the analysts down in any way, shape or form. If any of them are listening, they do a fantastic job in what they do. So they all help add to the mix and trying to obviously understand and lift the lid on what you guys as fund managers are trying to do. Again, jumping around a bit on the questions, so apologies for that. Just coming in, no one come through here. Does the more expensive, intense micromanagement result in a better return than a small company fund? So I guess I think Nick asked this question the other day, and I didn't pick up on it, so apologies, Nick. So we have small company funds that advisors can invest into, kind of early stage investment funds. We saw the Woodford Fund recently that unfortunately failed, but that was trying to invest in early stage companies in a unit trust or kind of situation. I think the question Nick's trying to ask is, apologies if you're not Nick, how does that compare with what you guys are doing, which is obviously slightly more expensive from a fund point of view, but obviously has a much more hands-on approach in terms of the fund management that you're doing with those companies. Fred, I'll go to you on that one.
I think I'm trying to get my head around the question. So sorry, Nick, if I don't answer it straight in the first go. I think in EIS, investing in early stage companies, there's especially in digital, which I think all the guys on the call do. There's significant room for significant returns. Now, of course, lots of advisors would argue it's a more riskier asset class than maybe some of those unit trusts or other funds, but we've seen failures in those markets as well. And it also, no doubt, obviously depends on the stage you invest in. So investing in companies that are sub £2-3 million valuation, which we do a pre-seed, or sub £10 million at seed, we're investing in companies that have ambition and we believe can get to 100 million plus in terms of exits. So for us, that's 10x return on an individual company level. And we're seeing that throughout the portfolio, and we're seeing that in tech. And you only have to look at the US stock market across tech for the last year or any period of time to see that influenced at a larger scale as well. So I don't know if that answers your question or not, Nick, but from our perspective, I see EIS as something that's extremely bullish, and investing in early stage companies in private equity or EIS or VCT or whatever it may be gives you the ability to get in early on that trend up.
Yeah, I think what Nick's looking for, I think that goes halfway to answering Fred, so thanks. But I think what Nick is looking for is a way to compare EIS to early stage unit trust and weak portfolios. Dan, you're almost comparing apples and pears, I guess, because you can't necessarily compare the two because they're two different vehicles and two different ways of approaching the investment philosophy. But yeah, I don't know if you have any thoughts on that.
I think it's a very good question. Because it's where the particular fund sits in the growth curve of the underlying asset companies, really. And I think it's something we've looked at as a business because, as EIS, VCT, the tax efficient and alternative space matures, it does need to be comparable to, wider main market products. I think, to the point of comparing returns, I think from an IRR perspective, and this is quite general across the industry, but generalizing, target returns on an EIS portfolio are quite similar to, a small companies fund in the main market. However, by definition, the volatility on the younger companies is such that you do have this capacity within an EIS to have, significant increases in upside returns on a company by company basis, and what EIS is also benefit from, against that volatility in the underlying companies, you've got tax mitigation on the downside. So, yes, I think comparisons of these kind of products and taking into account the tax reliefs available is something that the market should work towards. But in terms of where they sit, I think target returns are similar. But with these earlier stage EIS funds, you are looking at tax mitigation on the downside and potential for excess returns.
Yeah, and I guess the other point to make is obviously those type of funds are traded daily. They have liquidity. That's the point of an unit trust and a WIC portfolio. But obviously in our world, it's not the same case. The fact that you're valuing companies, but it's a bit of a finger in the air job, quite frankly. And until they come to exit, it's only a paper valuation in that sense. So it makes that more difficult. Andrew, you look like you're nodding and agree.
Yeah, totally. And I think it's important to remember. I mean, although those target returns might be similar, I mean, EIS is incredibly powerful medicine for investors. And when you consider that as an asset class, when you invest into EIS and you're an additional rate taxpayer, your floor or your downside risk is about 62.5 pence in the pound. So, if you were to invest onto small company growth trust that's listed, you don't have that floor on your returns. Whereas at least in EIS, you know that the very downside risk for you is 62.5p in the pound back, based on your tax position, assuming you can get all the tax relief that you can, but your returns are unlimited. And when you consider that the average returns in VC in the UK are around about 13% IRR, that is already compensating you for the risk return profile that you're taking on as an early stage investor, and you build in that floor. And then if you're able to invest, I mean, through Par Equity, we've now realized 136 investment rounds, and our IRR is 27%. So, when you consider that, it's extreme, and you've got that floor sitting beneath your EIS portfolio, and that's excluding, by the way, any EIS relief or returns, then it becomes incredibly interesting. So I do take the point that we do need to make a better job at comparing EIS versus the markets. But from our perspective, it's been extremely successful for our investors.
Sure. Again, just moving around slightly, actually going back to a question we were talking about earlier. I've got about 7 minutes to go, by the way, so we'll try and clear this one up. Dan, we talked earlier about fund failures and kind of company failures. So I just want to clarify a little bit. Company failures, obviously, if the company fails, you have share loss relief, and you can go down that road and get some of your tax back from that point of view. But obviously, you're losing some of your capital. Fund failure, you shouldn't lose anything technically. The assets should just move from this custodian to another custodian, and it can move across quite simply and easy. I know, Fred, you've been through this, so perhaps you're a better person to ask on how that works.
Yeah, so we've a custodian that we used to work with, Raker, a large custodian in the UK, went into special administration, and the process there is really important, Mark. You make a great point. There is nothing affected with us as fund manager, Hatch, or our underlying investments. It's solely that party in the middle that's holding those shares on behalf of the underlying beneficial owners, so our investors. And that process, although not straightforward, in terms of time, it just takes a bit of time to transfer that out. In effect, it really had no effect on our underlying investors, because these are not liquid companies that you're buying and selling every day. These are companies that you're investing in for a period of time. That could be 4 to 7 years. And as long as you have access to those companies, that's great. So I think that's a really important difference to point out, and we spoke about this a bit earlier, and Dan did. There's different layers of, the underlying companies in trouble, the custodians, and then the fund manager as well. I think the other bit that's worth pointing out is the beneficial owner of the stock always remains our underlying investors. So even in a scenario where a fund manager was to go and there was no one to pick up those underlying stocks, that investor ultimately could get them in the end, or they could be transferred out to that investor. And I think someone just raised a good point in the chat that the fund manager's job, and the reason they're paying the fund manager, is to find those companies and support those companies. And that's why we hold them in a custodian on behalf of our underlying investors.
Yeah, and the company itself, Dan, if that fails, generally in a fund at least, there's no FSCS, is there?
That's correct, but that should be an expectation, I guess, within this space. Not all portfolio companies are going are going to go the distance, and as such, that's where the loss relief. The good thing about the loss relief and the structure of an EIS fund is, as we said, the underlying beneficial owner owns shares in that company, and so they can claim loss relief on that particular company holding. So that's where you get your risk mitigation, but you're quite right, there's no access to FSCS in that context.
But there might be if you're investing in a single company. Yeah?
Potentially, yeah, depending on
potentially is the word. Potentially is the word.
Depending on the circumstances.
Caveat emptor, exactly. Look, so it's 10:56. We've got about 4 minutes to go, and as always, I want to be don't want to be a time thief and go past 11 o'clock. So it's really trying to wrap things up for today and the week, in fact. What I'd like to do is for each 5 of you, just go around the Zoom room and just say, look, it's tax year end, financial planners, busy people. What one piece of advice could you give them at this time of year to try and help them look at this market, to try and get to grips with it and have kind of sensible and competent conversations with their clients? Stephen, I'll start with you, that's okay.
Well, thank you. I would just ask financial advisors and planners to do a full review of the market, try and understand the sector in which the managers are operating in. I sit here as what I call a challenger fund. We're a small fund, work in certain ways. Please investigate, not just us, all the funds out there, and try and understand what they're trying to do, as opposed to, if I may say, just go safe and go with the bigger funds.
Sage advice. Andrew, you're next.
Yeah, I think echoing a point that I think was made earlier, which is just around building up a big enough portfolio of investments. So if you are an advisor and you're looking to advise your clients into EIS, and you want to do so by the end of the tax year, there aren't many managers that will be able to invest in that many companies in the next 3 or 4 months. So consider manager diversification, consider spreading your investors, your clients' money across several different managers to ensure that you build up a sizable portfolio of underlying assets.
Thank you very much. James?
Yeah, I mean, these are risky investments and relatively illiquid, but if you've, as an advisor, got clients for whom they've got the capacity and the appetite for this kind of risk, then there's a great opportunity. The tax benefits we all know and we're aware of that give the protection, but in terms of some great companies coming through, some great opportunities Fred mentioned in terms of new companies coming through, some portfolio companies that have been thriving during the last 12 months, and that are looking in great shape and have been rewarded with stronger valuations and great opportunities. So it's a great opportunity to invest for the right group of clients. And if you've got that group of clients, it's a brilliant time.
Thank you very much. Dan?
Well, just to echo what everyone said here, be diversified is a core message, really, and without wishing to appear too salesy, get in touch with platforms like ourselves, discuss the whole of market view that we have across EIS, and then access multiple funds in one simple solution. That is imperative for me in terms of diversifying the risk on these client portfolios.
Fred, I bless you last again. Apologies, but Fred, final word.
Something exciting. Invest in something that you find exciting. I think we often talk about tax reliefs and diversification, and I think that's all absolutely correct and plays a big part. But ultimately, I think you should invest in something that resonates with you, or that you find an interesting emerging manager, or they're investing in some interesting companies. So absolutely, I agree with everyone's points. Back emerging managers, spread your investment between more. But find something that's exciting, find something that resonates with you, something you buy into, get excited about the underlying companies or the performance of the fund. Make it a cool industry, be excited.
And boy, do we need something exciting at the moment, all sat here in lockdown. So yeah, I think that's a good call to arms to finish with, Fred. So thanks very much. So look, it's just clicked 11 o'clock, perfect timing. So thank you very much for joining us again. If you have joined us for every day this week, thank you. I know it's the first working week back into work, back into the mix, as it were. So thank you for joining us. We'll be doing these again, probably sometime towards or after the tax year ends. I know it's such a busy period. It's not the best time to do them. I just put some links up in the chat there One is to our fee transparency, which also links to co-investors calculator, so have a look at that. We've also got all of the webinars that we've done this week on video, so I'll put a link to those. And finally, those kind of 10-minute snippet videos that we've done with each of these guys and all the other panelists during the week. They're all available, and I've put a link to that as well. So lots of information, content for you to catch on if you have missed anything during the week. Just leaves me to say thank you very much. We will send out an email probably next week, just kind of wrapping things up for this week in terms of CPD certificates, contact details for these guys and girls, and a little bit more information coming through about what we'll be doing over the course of the year as well. But that just leaves me to say thank you to all our panelists from today, from the last week that we've had. Please do enjoy your weekends, go out and do stuff that you can't do. Actually, no, we'll all stay at home, but please do try and enjoy it in some way, shape or form. If you need anything, please do get in contact with us at ESA, www.esa.org.uk. Thank you very much. Enjoy your day.
Thank you.
Thanks. Bye.